Welcome back. Well, yesterday we had a slew of economic reports that were released. Retail sales increased 0.3%, beating the flat expectations. That's actually probably one of the bright spots in the news yesterday. Philly manufacturing index declined to negative 9.9. That was a disappointment. Empire State Manufacturing Index improved to a negative 1.5 following the estimates of a negative 12.9, but we'll see the number actually was not that good. Industrial production slightly declined. Capacity utilization also slightly declined. Business inventories increased, but that matched expectations. Looking to the charts, Philly manufacturing outlook, almost the lowest low we've seen in quite a while. Steady trend to the downside. Although the New York Empire numbers were higher, beating expectations, we can see overall the chart is registering lower lows and lower highs. Certainly not a good picture in either manufacturing index. Business inventories still maintaining a steady trend to the upside, but capacity utilization and industrial production now ticking a little bit lower. That's on one negative report. It's not, certainly a trend yet. Advanced retail sales, just slight improvement to the upside. In terms of the statistics, again, the Philly Manufacturing Index released at a 4.6 level, almost the lowest low we've seen over the past 10 months. New York Empire Manufacturing was negative 1.5, not as bleak as last month with a negative 31.3, but not great either. Taking a look at business inventories, that did register a new high. That was also some good news we saw yesterday. But industrial production, capacity utilization, missing or registering a slight decline near the upper end of the range as far as the raw numbers, but not new highs. Taking a look at the Philly Manufacturing Index and then, of course, the New York Empire Manufacturing Index, weakness across the board. The manufacturing numbers, they've been on the opposite side of the spectrum than inflation. Inflation's been very strong. Manufacturing, logically, has been very weak. On a year-over-year basis, we can see advanced retail sales this August compared to last August, improving by 8.9%. That, again, was, in addition to business inventories, is one of the better numbers we saw over here. Here's business inventories, also, almost a new high. But that really was the good news. Aside from that, we have, of course, New York Empire numbers. Not the lowest low, but definitely near the lower end of the range. And then the bad news, the Philly manufacturing outlook. One of the worst numbers we've seen in quite a while. This is one of our custom indicators we've put together. Now, specifically, we take a look at the green line, which is our growth index. It's made up of a combination of retail sales, industrial production, capacity utilization, non-farm payrolls, durable goods, business inventories, and manufacturing inventories. It ranks the report in respect to its 12 most recent reports. So if it was the best number in the past 12 months, it would register 100%. If it was a worse number, it would register a 0. So it's near the upper end of the range, but it is now declining. And if you take into consideration what we saw back in the decline of 2008, 2009, with the financial crisis, the red line, which is inflation, the green line, which is growth, and housing, which is the blue line, all registered the lowest lows we saw in quite a long time. Well, housing is not making new highs. It's near the 80 percentile, but it's certainly not making new highs. And on that note, also the red line and green line are moving lower. Now, the PPI, I think, contributed to the red line, the inflation index moving lower. But I think the Federal Reserve probably watches the PCE, personal consumption expenditure, a little bit closer than it does the PPI. And certainly the CPI was very hot. Point being is that if growth continues to slow, especially taking into consideration with a lackluster housing index, certainly does not paint a very bright picture. Now, taking a look at the bond market, the red line, top right-hand side, it represents the total bond yields. If you add up all the yields from the 30-year bond all the way down to the 1-month bond, we see the expectation of higher interest rates. We see higher highs all the way through. There's more yield in the bond market as we expect overall the Federal Reserve to continue to raise interest rates in light of inflation. However, and that makes sense because the blue line, which is the S&P 500, just continues to register lower lows in light of the expectation of higher interest rates. But take a look at the green line. The green line in the center of the chart shows us the combination of all the bond spreads. For example, we have the 30-year bond pays 348, the 20-year bond pays at 375. That represents a negative 27 basis point inversion. And we see the green line, which represents all the different bond spreads, the 30 to the 20, the 20 to the 10. Overall, they continue to compress. And that's showing us a very unhealthy condition within the bond market. Take a look at the 1-year bond now paying 4% versus the 10-year at a 345. The 1-year bond compared to the 10-year represents a 0.55% inversion, or negative 55 basis points. When yields go up, it means the prices for those bonds are going down. Traders are selling the 1-year bond and buying the 10-year bond. They're nervous about the 1-year outlook, more confident about the longer-term outlook. But we can see, and it's a really unusual phenomenon in the fixed income markets, as the overall yields go up, well, that's the result of the short-term bond yields going up, not so much the long-term bonds. Take a look now. Again, we had a very strong correlation between the S&P 500 and the 30-20 spread. That correlation did pause for a couple days. It's back now, though, and we see this here. Take a look at the black line, which represents the S&P 500, the orange line, which represents the 30-20 spread, the difference between the 30 and the 20 yields. That's a negative 0.27% yield. As the stock market goes down, traders are buying the longer-term 30, selling the shorter, relatively shorter-term 20-year maturity, and the inversion, the difference between those two to the downside, does increase as the S&P 500 has made new lows over the recent past. Well, we could logically expect this inversion to continue and actually to accelerate. Now, in a normal bond market condition, we expect to see, such as in this past January, the top right-hand chart, the 1-month bond pays the lowest yield. The 30-year, well, almost the 30-year, pays the highest yield. This was a 20-year. We expect this slope to go up. But take a look to see in August, we saw this curve flatten out and actually move down. The 10-year bond paid a lower yield than the 1-year bond did. Well, this last chart on the right-hand side shows us the current state of affairs, and it's even more of an inversion. We see the 1-year bond pays a very high interest rate, much more than the 10-year. And that inversion, that acceleration inversion, reflects a continuing deterioration in the fixed income market, lack of confidence in the near-term future. And we can compare this also. Overall, we see the red line, again, represents a total bond yields. As the expectation of higher interest rates continues to rise, we see the overall bond market offer higher yields. But if you were to add up all of the spreads, the 30 to the 20-year, the 20-year to the 10-year on down, put all those spreads together, that's the blue line. And this is not a healthy market. In a healthy market, we'd expect to see the red line and the blue line move in the same direction. What this is showing us is, despite the fact that we expect higher interest rates, we're seeing higher interest rates only emerge on the short-term bonds. And as bond yields go up, it means the prices are going down. It means traders are selling aggressively those short-term bonds in the expectation of a bleak, at least near-term future. Now, last but not least, we can consider the bond meter as well. The orange area chart represents our S&P 500. Certainly has been very weak over the past week or so. The blue line represents the culmination of long-term bond spreads, the 30 to the 20, the 20 to the 10. The red line represents the medium-term spreads, the 10 to the 7-year maturity, the 7 to the 5, the 5 to the 3, and the green line represents the short-term yields. Notice, as we had a massive stock market sell-off in June, the green line really went up, means that traders sold the short-term bonds and those yields went up. They bought the long-term and the medium-term bonds. The blue and the red line went down. Well, we see that pattern continue and actually register lower lows over the past week, as the green line, the short-term bonds, represents higher highs. So if you want to know where the capital is going as the stock market goes down, it's going into the long-term bonds. It's running away from the short-term bonds, which again continues to confirm, and this is what we like to see, convergence and agreement between different financial markets. As stocks go down, capital is moving out of the short-term bonds into longer-term maturities, kind of confirming the lack of confidence, at least in the near-term future. Of course, all this could change, and we're going to be watching next week's numbers. We have some housing numbers, and more importantly, we have the Federal Reserve meeting, and that's going to certainly play a very significant role in the direction of equity and fixed income markets. Well, we thank you for joining us. We wish you a great weekend, and we look forward to seeing you back soon.